Hello, and welcome to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hemoen, and today we're diving into a smorgasbord of good news for Canadian mortgage borrowers. This past week has been a whirlwind of positive developments in the mortgage world, with significant implications for both current and prospective homeowners in Canada. Let's break it all down and explore what these changes mean for you. First up, Canadian inflation has returned to the Bank of Canada's 2% target much earlier than anticipated. According to Statistics Canada, the Consumer Price Index fell from 2.5% in July to 2% in August. This sharp cooling of inflation is a promising sign, as it suggests that the Bank of Canada may soon ease its monetary policy. Currently, the policy rate stands at 4.25%, but with inflation no longer necessitating such restrictive rates, there's a rising likelihood of a rate cut at the next Bank of Canada meeting on October 23rd. Meanwhile, south of the border, the United States Federal Reserve has initiated a rate cut cycle with a bold move, reducing its policy rate by 0.5%. This decision is part of a strategy to address potential weaknesses in the U.S. employment market and signals a shift towards more accommodative monetary policies. The Fed's board members are projecting further rate reductions over the next couple of years, which could lead to a total reduction of 2.5% by 2026. This development is noteworthy for Canadian borrowers as it hints at potential similar movements by the Bank of Canada. In a surprise move last week, the Canadian federal government announced sweeping changes to its mortgage default insurance policies, set to take effect on December 15, 2024. These changes include increasing the maximum purchase price for borrowers with down payments of less than 20% from $1 million to $1.5 million. Additionally, the maximum amortization period for first-time homebuyers and purchasers of newly built homes with down payments of less than 20% will be extended from 25 to 30 years. These policy changes are designed to make housing more accessible, offering some near-term relief for eligible buyers. By increasing affordability, it's expected that developers with unsold units may see a boost in demand, and lenders can offload more default risk to the taxpayers. However, while these adjustments may provide short-term benefits, they don't address the underlying issue of high demand outstripping supply in the housing market. It's a delicate balance, as these measures might make housing more affordable for some now, but could lead to increased debt and higher house prices in the future. In terms of mortgage selection advice, the recent developments in Canadian inflation and U.S. Fed policy reinforce the potential benefits of variable rates. Variable rates are likely to fall substantially, making them an attractive option despite the upfront premium. If the Bank of Canada follows through with rate cuts, variable rates could outperform fixed-rate options. However, for those who prefer the stability of fixed rates, 3-year fixed terms are currently advisable over 5-year terms, given the current interest rate cycle. To wrap up this segment, the overarching theme is one of cautious optimism. With bond market investors pricing in an aggressive rate cut timetable for the Bank of Canada, there's potential for both fixed and variable mortgage rates to trend lower. As we navigate this evolving landscape, it's crucial to stay informed and consider how these changes might impact your mortgage decisions. Stay tuned for more updates as we continue to monitor these developments closely. The Canadian federal government is taking significant steps to address the housing shortage by launching a new mortgage refinancing program aimed at boosting the construction of secondary suites. Announced by Deputy Prime Minister Chrystia Freeland, this initiative will allow Canadians to access up to 90% of their home's value through default-insured mortgage refinancing starting January 15, 2025. The goal here is twofold: to increase the rental supply in high-demand areas and to help homeowners manage their rising mortgage costs. As part of this program, homeowners can refinance up to 90% of the as-improved property value, with the total property value capped at $2 million. This is a significant move, as it allows homeowners to spread payments over a longer term with a maximum amortization period of 30 years. Homeowners will have the opportunity to add up to 4 units on their property, including the existing one, provided each secondary suite is a fully self-contained unit. This means separate living facilities, such as a private entrance, kitchen, and bathroom, ensuring compliance with municipal zoning requirements. There are some stipulations to consider. The additional units must be used for long-term rentals and cannot be converted into short-term rentals, like those on Airbnb. This is designed to ensure that the program genuinely contributes to easing the housing crunch by increasing long-term rental availability. This announcement follows other recent government initiatives, such as changes to mortgage rules that increased the cap on default insurance and reintroduced a 30-year amortization option for some borrowers. In addition, Canada's banking regulator, the Office of the Superintendent of Financial Institutions, is planning to remove the stress test requirement for uninsured mortgage switches. This had previously been a barrier for homeowners looking to switch lenders. The federal government is also taking steps to unlock vacant land for housing development. Deputy Prime Minister Freeland has initiated consultations on taxing vacant land, encouraging landowners to develop unused lots. This move is part of a broader strategy to push landowners to make better use of their property, ideally leading to more homes being built. Moreover, 14 more underused federal properties have been added to the Canada Public Land Bank, totaling 70 sites now available for development. The aim is to transform these properties into new homes, aligning with the government's plan to add more housing. A recent report from Royal Bank of Canada reveals that new listings continued to climb in almost all of Canada's major real estate markets this September, with Montreal being the notable exception. This increase in inventory has helped alleviate some supply pressures, yet buyer activity remains sluggish. According to Rachel Battaglia, an economist at Royal Bank of Canada, many markets are in a state of pause due to high interest rates affecting affordability. Battaglia notes that even with 75 basis points worth of interest rate cuts, buying activity has not picked up across the board. Canada's most expensive markets, Vancouver and Toronto, are experiencing modest fluctuations, keeping activity relatively stagnant since the spring. Easing supply-demand pressures are contributing to a downward trend in prices in these markets. In Toronto, buyers are adopting a wait-and-see approach, hoping for more rate cuts or a more significant drop in home prices before entering the market. The increase in new listings, largely driven by condo completions, has eased some earlier supply constraints, but this has not translated into a notable rise in sales activity. While Toronto's resale activity increased by a modest 3.3% from August to September, the surge in new listings was 3 times the number of homes sold. Year-over-year prices in Toronto have declined for 6 consecutive months, down 4.6% in September. Battaglia explains that given the accumulated inventory, it will likely take some time for the market to absorb the excess. This situation is expected to keep supply-demand conditions in favor of buyers for a while longer. Meanwhile, Montreal's real estate market is showing signs of stabilization. Despite a 5.5% drop in resales in September, the decline in new listings was even steeper, which is helping to balance the market. Battaglia suggests that supply-demand conditions will remain balanced as more inventory is released from newly completed projects. Buying activity is also anticipated to increase in the coming months, as the Bank of Canada announces additional rate cuts. In Vancouver, the housing market is slow to recover from its cyclical low, despite a 4.9% seasonally adjusted rise in resales in September. This increase follows 2 months of declines, but overall activity remains weak. Home sales have remained under 27,000 for over a year, keeping transactions 16% lower than in September 2019. Inventories continue to rise in Vancouver, putting downward pressure on prices. Home prices in the Greater Vancouver area were down 1.8% year over year in September, and this trend is expected to persist in the near term. Battaglia points out that affordability is still extremely stretched in the Vancouver market. As such, potential buyers may need to see more substantial rate reductions before affordability improves enough to attract new market entrants. On the other hand, Calgary experienced a 5.4% increase in new listings in September, providing relief in a market that has faced tight supply for much of the year. Although the surge in listings has moderated price growth, demand remains strong, driven by population growth and a relatively optimistic economic outlook. Annual price growth in Calgary slowed in September, nearly halving the rate recorded earlier in the year. However, the city remains one of the few markets where resale activity is still above pre-pandemic levels. Battaglia concludes that supply-demand conditions in Calgary continue to favor sellers, as inventories are still historically low. This is expected to prevent prices from moderating significantly in the months ahead. In the ever-evolving world of mortgage lending, artificial intelligence is becoming an increasingly significant topic of discussion. With 2025 on the horizon, the initial excitement surrounding AI's potential to disrupt the mortgage industry has been tempered by more realistic expectations about its future role. At the recent Canadian Mortgage Summit in Brampton, industry leaders gathered to discuss the shifting landscape of AI in the mortgage space. Dong Li, the Chief Executive Officer of Axiom Innovations, addressed the evolving perception of AI in the mortgage sector. He highlighted that while AI holds the promise of being a game changer if applied with skill and innovation, many AI projects, like any tech development, are destined to fail. Lee shared insights from a recent visit to the U.S. Digital Mortgage Conference in San Diego, where he observed that numerous companies were investing heavily in AI. Despite the impressive prototypes and ideas, many found that practical application was challenging. Lee's observations suggest that fears of AI posing an existential threat to professions such as mortgage brokering may be overblown. Instead, he sees opportunities emerging around generative AI, offering new marketing tools and options. Anybody who thinks that this AI stuff is going to take us out of business and we're all going to lose our jobs is sorely mistaken, Lee stated. The regulatory environment is also playing a role in shaping AI's future in the industry. In the United States, there's a growing focus on AI regulation, particularly concerning chatbots that might provide incorrect or misleading information. This has led some companies to scale back their AI projects, using AI tools internally to aid underwriters rather than deploying them directly to consumers. Lee suggested that Canada might follow a similar path, which he views as a positive development for the industry. Derek Mathewson from Philogix explained his company's cautious approach to AI integration. Rather than introducing standalone AI features, Philogix is embedding AI capabilities into existing systems, such as chatbots for answering specific product-related questions and auto-composing emails to clients and lenders. We want to ensure these tools work effectively and don't just rely on AI blindly, Mathewson emphasized. Jared Stanley from Neighborhood Holdings echoed the sentiment of careful AI adoption. His company has developed an AI tool that summarizes broker notes, but he cautioned against assuming AI's suitability for every task. While AI can technically handle inquiries about lending guidelines, Stanley noted that brokers often prefer human interaction for such discussions. Tom Hall, founder of Blue Mortgage, emphasized the importance of focusing on AI applications that truly add value. While AI has the potential to revolutionize the industry, Blue Mortgage is concentrating on streamlining daily tasks with currently available tools. Hall stressed the need to cut through the noise and hype, exploring how AI can enhance existing workflows without overpromising its capabilities. Canada's revised mortgage rates for 2024 are bringing significant relief to homeowners and first-time buyers across the country. With these changes, the government aims to make homeownership more affordable, particularly in high-cost markets like Toronto and Vancouver. Let's dive into the details and see what this means for you. The Bank of Canada has been on a downward trend with its interest rates throughout 2024. After reaching a peak of 5% in 2023, the bank has now reduced its policy rate to 4.25%, following 3 consecutive cuts this year. This 75 basis point decrease is aimed at providing relief to mortgage holders with variable rates and spurring economic growth by lowering borrowing costs. These rate cuts have had an immediate impact on mortgage rates, particularly for those with variable rate mortgages, which directly fluctuate with the central bank's policy rate. For homeowners with adjustable rate mortgages, the reduction in rates translates to lower monthly payments. For instance, a homeowner with a $667,000 home and a 10% down payment saw their monthly payment decrease by around $70 after the latest 0.25% rate cut in September 2024. In addition to rate cuts, the Canadian government has introduced significant mortgage reforms aimed at making homeownership more affordable, particularly for first-time buyers. One of the most impactful changes is the increase in the insured mortgage cap from $1 million to $1.5 million. This adjustment, effective December 15, 2024, reflects the rising housing costs in major cities like Toronto and Vancouver, where the average home price often exceeds $1 million. With this increase, more homebuyers will be able to qualify for insured mortgages with a down payment as low as 5% on the first $500,000 of the home's price and 10% on the remaining amount above that. For example, a buyer purchasing a $1.5 million home would now only need a down payment of $125,000, a significant improvement for those in high-cost markets. In a bid to further reduce monthly payments, the government has expanded the availability of 30-year amortizations for insured mortgages, which was previously limited to newly built homes. As of December 15, 2024, all homebuyers will be able to access 30-year insured mortgages, reducing their monthly payment obligations by around 9% compared to the standard 25-year amortization. For buyers struggling with affordability, particularly in high-price areas, this longer amortization period offers substantial financial relief. Lower monthly payments make it easier for buyers to enter the market, and investors can now finance pre-construction homes under these terms, potentially boosting the rental market. Another significant change is the ability to switch mortgage lenders without undergoing another stress test at the time of renewal. Under the Canadian Mortgage Charter, insured mortgage holders can now shop around for better rates without having to requalify. This increases competition among lenders and allows borrowers to secure lower rates, further easing the financial burden on Canadian homeowners. The combination of government policy changes and rate cuts from the Bank of Canada is expected to have far-reaching impacts on homeowners, investors, and the broader housing market. First-time buyers in particular stand to benefit from these changes. The 30-year amortization offers lower monthly payments, making it easier to afford homes in high-cost cities. Additionally, the increased insured mortgage cap expands access to government-backed insurance, which could be a game changer for those entering expensive real estate markets like Toronto and Vancouver. Moreover, with interest rates on a downward trend, first-time buyers can expect better mortgage deals in the latter half of 2024. Analysts forecast that the 5-year fixed mortgage rate could drop to 5.4% by the end of the year, down from its peak of 6.4% in 2023. For homeowners, especially those with variable rate mortgages, the recent interest rate cuts have brought much-needed relief. Variable rate mortgage holders have already seen a drop in their payments, as the prime rate at most lenders has dropped to 6.45%, down from 6.7%. Those with fixed payment schedules will also benefit as more of their payment goes toward the principal rather than interest. Additionally, the ability to switch lenders without requalifying is a boon for homeowners approaching renewal. This change allows borrowers to negotiate better terms and avoid being stuck with their original lender's rates. Real estate investors, particularly those involved in pre-construction homes, are set to benefit from the availability of 30-year amortizations for these properties. The longer repayment terms provide a cushion against rising housing costs and could stimulate renewed interest in the pre-construction market, which had seen a slowdown due to increasing prices and higher interest rates. In summary, Canada's revised mortgage rates and policies for 2024 are set to offer substantial relief and opportunities for homeowners, first-time buyers, and investors alike. By lowering interest rates and expanding access to insured mortgages, the government is taking significant steps to make homeownership more accessible, especially in high-cost markets. As we move forward, it's crucial to stay informed about these changes and how they might impact your mortgage decisions. That's it for today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found these updates helpful as you navigate the ever-changing landscape of the Canadian real estate market. Remember, staying informed is key to making well-informed decisions. Join me next time as we continue to explore the latest in mortgage and real estate news. Until then, take care and stay savvy.